friends, welcome to the unit number 10 of AVFM theory discussion session, complete theory in English discussion, and the chapter name, as you can see, is capital budgeting for international project investment decision. So in the previous lecture, that is our unit number 9, we have discussed regarding the capital budgeting. We have seen the different techniques which we can use for capital budgeting like NPV, IRR. Then we have something called we can compare using profitability index, right? So we have seen all these things in the previous lecture, and now in this lecture we will see, let's see what are the topics which we have to discuss. We will see the introduction part, then we will see the foreign investment analysis. We will do the foreign investment analysis properly, right? And after doing this foreign investment analysis, we will see the international capital budgeting. Then after we will see issues involved in evaluation of overseas project. What are the issues involved? Approaches for evaluation of overseas project. That means how do we approach evaluation of overseas project, and then evaluation methods, and finally we will see the impact of transfer pricing. I hope you are familiar with this term, so called transfer pricing. We have covered it in BFM. So without wasting our time, let's start with our first topic, that is our introduction. Right. So first of all, what is this capital budgeting all about? As the topic name itself suggests, this capital budgeting. So let me give you an example to make it more clear. Imagine you are planning to buy a house. You would not just pick the first one you see, right? You would consider the location, you would consider the price, you would consider the future value and your long-term goal. You look into all these aspects while buying a house, right? Similarly, company don't just spend money on big asset without careful planning, right? So company, what they do, they use something called capital budgeting, right? To decide where, to decide how much, right? To decide when to invest, where, how much and when to invest, right? So in the to invest in the long term asset like new building, machinery, or even expanding to another country. So what is the goal? The goal is, the objective is quite simple. The objective is that to ensure sustainable growth. So let me highlight the key point: to ensure the sustainable growth, right, and maximize return. So to ensure sustainable growth and maximize return while minimizing risk. So you can see clearly written here, to ensure sustainable growth is there, expected to maximize return while minimizing risk. That is the goal, right? So every rupee spent must be justified with solid number and logic. Now then we have something called investment internationally. It gets risky, right? Expanding business abroad is not as easy as setting up shop next door. Obviously expanding international abroad is risky, right? So because you need to understand the local laws and regulations, we have to consider the various aspects, like you have to see the laws, you have to see the regulations, right? You have to see the work culture, you have to see the business tradition, and also currency difference will also affect it. Currency difference and exchange rate, political stability, this is the important point. And finally we have something called accounting standard, which you must see, accounting standard. So friends, ignoring this could turn a dream investment into nightmare, right? So stay tuned, as I hope this make your concept clear. So capital investment require deep analysis. Major issues like difference in work culture, legal system, currency system, business tradition, accounting standards, so they plays a key role. So now let's discuss the foreign investment analysis. So I hope I have given you that what is the importance of capital. I have told you what is the importance of capital budgeting, and especially in the case of international when we deal with international, then there are some risk which arise. Then we have to take care of the law, legal, traditional, accounting standards, trade barrier, local language, etc. Now let's discuss, have you ever thought about what happened when a company invests abroad? It is not just about setting up an office in another country. Money moves across border, currency fluctuate and risk multiply. So let's talk about the currency game. Let's talk about this so-called the currency game. Why it is crucial, why this currency game is so crucial. Let's understand it. Imagine you are an Indian company investing in US. So let me explain it using an example. So suppose you are an Indian company, right, and you are investing in US, right? So your profit will be in dollar, you know it very well. So but when you bring that money back to India, it will be converted to rupees. So that when you bring that money back to India, it will be converted to rupee, right? So the question is, the big problem is that currency fluctuation, right? So the big problem is what we have, currency fluctuation, right? So the exchange rate today won't be the same a year later. Obviously today exchange rate will not be equal to the year later exchange rate. So if the dollar weaken against the rupees, your profits sink. So if the dollar weaken, if dollar become weak against rupees, so because your profit is in dollar, right? So profit is in dollar. Since dollar weaken, so your profit will shrink, your profit will decrease. So and if the dollar is strengthen, you earn more, right? So that is why I hope it make you clear the currency fluctuation, how does it play the important role, right? Because your profit is in dollar. If dollar become weak, your profit become less. If dollar become strong, your profit will be more. So why projection are critical? Foreign project takes time to set up. Yeah, right. Foreign project takes time to set up, and in that time currency rise and fall unpredictably, right? Foreign projects take time to set up, and what happened during that time? Currency rise, currency fall unpredictably. That is why company need something called accurate prediction. Company need accurate projection in foreign currency, right? So careful adoption of currency conversion rate, accurate projection must be accurate. Then we have constant monitoring should be done. Then we have detailed spreadsheet to analyze different scenario. Now the question is, how does it impact the business? Okay, so projection, how is the projection important? I come to know that foreign projects take time to set up, and in that time currency rise and fall unpredictably. So company need accurate projection, constant monitoring, and detailed spreadsheet to analyze different scenario. Now the question is, how does it affect business? Every kind of financial activity, whether it is import, export, borrowing, repayment, right, dividend, repatriation, every kind of export activity, every financial activity get impacted by exchange rate. You know it very well. Import, export, borrowing, repayment, dividend, repatriation, all get affected by the exchange rate, right? So a bad rate can wipe out profit. So if your rate is bad, what will happen? It will wipe out profit, right? It will wipe out your profit, while a favorable one can boost earning. So choosing the right currency matter, right? Choosing right currency, it matters. Why we know? Because when we deal with two currency, company must decide which one to use for planning. Should it be in dollar or rupee or a mixture? The decision depends on which currency gives a clear financial picture, right? How to decide it? Because the decision depends on which currency gives a clear financial picture, right? So while we dealing with two currency, company must decide which one to use for planning, right? So that is called multiple scenario maybe need to be considered for comprehensive analysis, right? So I hope this makes sense to you. So choice of dominant currency should be based on project perspective. Then we have the next point, that is foreign currency discount rate computation. How to go about computing it? So friends, have you ever thought about how company or individual invest outside India? So you are investing outside India, right? Outside India. So the question is, how do company or individual invest outside India? How do they convert money? How do they handle exchange rate? And how do they reduce risk while investing globally? Let's simplify this tricky concept in today's session. So the first question we will answer, let me write down, is this: how do we convert currency for investment? How do we convert currency for investment? How do we convert currency for investment? So when an Indian company invests abroad, it needs to convert rupee into dollar, euro, or yen, right? Japanese pound. So pound, not dollar, euro, and pound, right? But here is the catch: conversion happen at the spot rate. Conversion always happen at this spot rate, right? What is the spot rate? A spot rate simply means the current exchange rate. So when Indian company invests abroad, it needs to convert rupees into dollar, euro, or pound, and this conversion always happen at the spot rate. And now this spot rate changes. Depending on the forms of money. So this spot rate depends on the form of money, right? So cash, traveler check, telegraphic transfer, all have different rate. You see, this spot rate depends on the form of money. So what we just learned, that whenever a company want to invest outside, right? So what happen, that it happens at the whenever an Indian company invest abroad, it needs to convert rupees into dollar, euro, or pound, right? But here is the catch, that this conversion happen at the spot rate. Conversion should happen at the spot rate, and this spot rate depends on the form of currency, whether it is notes, traveler's check, or telegraphic transfer. Now what if company plan to invest in the future instead of today? Suppose company don't want to invest today, rather the company want to invest in future. What will happen? So I hope I have answered the question that how do we convert currency for investment, right? So it is done at the spot rate. Now if the company plan to invest in future instead of today, that is where forward rate comes into picture, right? And you know it very well. What is the formula for forward rate? Let me again emphasize it. So the formula for forward rate is quite simple. So it is nothing but you first write the spot rate. You multiply it by interest rate adjustment, right? So that is the formula. Multiply the spot rate by the ratio of the interest rate and adjust for the time until the expiration. So you know this formula, which is our forward rate is equal to a spot rate multiplied by interest rate adjustment. This formula adjusts for interest rate and time, helping business lock in rate for future transaction. Without this, they risk losing money if the currency fluctuate, right? So I hope this makes sense to you, right? So now I have answered the question that how do we convert currency for investment. This depends on whether the transaction, whether the investment is done today or in future. If it is done today, it is done at a spot rate, and if it is, and spot rate depends on the types of currency being used, whether it is a foreign exchange, whether it is a forward okay, what type of currency is there. So that depends on that. Traveler check, telegraphic transfer, and for future contract, you know, forward contract rate is used, right, which is adjusted for interest rate and time. And to calculate the forward rate, we multiply spot rate by the ratio of interest rate and adjust for time until expiration, right? So I hope this makes sense to you. So now let's discuss investment in foreign security, right? So what about investment in foreign security? So friends, you know, this is called IPI. What is the full form of IPI? International Portfolio Investment, IPI. So we are investing in, let me write it down, we are invested in foreign security. Here we are investing in foreign security. So thanks to the globalization, investment is no longer restricted within national border. Because of the globalization, investment is no longer restricted within the domestic border, within the national border. Indian investor can now buy stock, bonds, as well as mutual fund in foreign market, just like they do in India. So Indian investor, you know, they can buy a stock, bond and mutual fund in foreign market just like they do in India. Now the question is, how does India allow it? Let's answer it. How does India allow it? Means foreign investment. The first way is called LRS, Liberalized Remittance Scheme. I think you know about it. You know, through the Liberalized Remittance Scheme, Indian can legally send up to US $250,000, right, per year for what? For, you can see, for various purpose, including investment in global market, buying foreign stock, travelers or foreign stock, mutual fund and bonds, and for funding education, travel or medical expense. Now the question is, why to invest internationally? Why invest internationally? Right, because you know there are more opportunities, right? Because there is more opportunity in the developed and fast growing market, and also you know there is a better data analysis available, the better data analysis for a smart decision making. And you know that some stable currency like US dollar as well as this euro reduces the risk, right? So that is called stability of exchange rate. So the foreign exchange rate like US dollar and euro are stable in nature, so they reduce the risk. And finally, diversification. This diversification lowers the risk and boosts the return. So because of these four reasons, foreign investment is it looks most exciting. The first reason I told you, that more opportunity in the developed and fast growing market. This is the key word, opportunity. The second I told you, that better data analysis become better. The third is a stable currency, the stability of exchange rate, and the fourth is diversification, right? So understanding foreign investment is very crucial for CAIIB. So now I hope I answered your question that have you, so friends, how do they convert money, how do they handle exchange rate, and they reduce the risk when investing globally, how it helps in risk reduction through diversification, right? Stability of exchange rate, these opportunities is there, proper analysis and studies are there. So because of this reason, investment is done abroad, and I have just told you about the LRS, Liberalized Remittance Scheme, right? Now let's talk about this so-called diversification in detail. How does diversification help? So want to know how big investor reduce risk and maximize return when investing globally? The secret lies in the diversification and the small asset allocation. So let's discuss it now. Diversification. So imagine you have all your money in one stock and it crashes overnight. Huge loss, right? That is why smart investors spread their money. So let me write down the keyword, spread their money. Smart investors spread their money, right? So what is the benefit? The first benefit is that steady return. Steady return, you know, even if one market slows down, other can balance the loss. The second reason is the capital appreciation. You know what it means? That over the time, a well diversified portfolio grows in value. And the final, is better risk return trade off, which means that investing across country lower risk while increasing profit potential. So these are the three benefit of the diversification. Let me again remind you: steady return, it means what? Even if one market slow down, other can balance the loss. Capital appreciation, it means over the time a well diversified portfolio grows in value. That is called capital appreciation, grows in value. The third, is better risk return trade off, which means investing across country lower risk while increasing profit potential. Now, there are some barriers to this global investment. So what are the barriers? Let's discuss now. The first barrier is that capital flow restriction. So let's discuss it one by one. The main barriers. The first barrier is the impediment in the capital flow, or we call it the capital flow restriction. That some government limit how much money can enter or leave their country, obviously. So there is an impediment, there is a restriction imposed by the government how much amount can leave or enter a country. Second reason, high long-term risk. Right, let me write it down, the very important. Here you can see higher risk in long term, that is called higher long term risk. Global market fluctuate and regulation may change anytime, and because of this there is a higher risk in the long term. The third reason, the third barrier is price control. You can see price control here. Price control means what? Foreign government may fix prices to control inflation or social stability, impacting investment return. And then we have something called language barrier. You know what is language barrier? That getting accurate financial information can be tough if you don't know the local language. So these are the main barrier, right? So basically, if you are investing abroad, is not a smooth sailing. Here is what can go wrong. Either capital flow restriction may rise. When I say capital flow restriction, it means that the government limit how much money can be enter or leave a country. Second, pricing control can be there, right? Which means foreign government may fix price to control inflation. Or long term higher risk can be there, higher long term risk, like global market fluctuate and regulation may change anytime, and language barrier is also there. So these are the kind of barrier. Okay, so we have discussed both the thing. We have discussed the advantage like diversification, and also we have discussed the limitation of it. Now let's discuss asset allocation, that is balancing risk and liquidity. Obviously risk is there, obviously liquidity is there, but how to balance them? What is asset allocation? What is the meaning of this so called asset allocation? Think of it as a perfect recipe for investment success. Means you mix high risk and low risk asset in the right proportion. When I say asset allocation, what you do? You mix high risk and low risk asset in the right proportion. So why is this important? Because it is important that it keeps your portfolio liquid. It keeps your portfolio liquid, ensuring you can withdraw money when needed. Right? For redemption. Redemption means you can withdraw money. So you can withdraw money when required. So that is called liquidity. It keeps your portfolio liquid, ensuring you can withdraw money when needed. And it helps avoid idle fund. It helps avoid idle fund, which means your money is always working for you. Right, that is why this allocation is quite important. Allocation simply means that allocation just means that perfect recipe. That means you mix high risk and low risk asset in the right proportion. There are some high risk asset, there are some low risk asset. You mix them in the right proportion, and this is what we call asset allocation. And why it is asset allocation necessary? The first reason is liquidity. Why liquidity? Because it keeps your portfolio liquid, ensuring that you can withdraw. Well, what is the meaning of liquidity? It simply means that you can withdraw money whenever you require. And also it avoid idle fund. Idle fund means what? Meaning your money is always working for you. And the third reason is high rated security or high rated investment for stability and growth. So understanding diversification and asset allocation is a game changer in finance and CAIIB. Right. So I hope this makes sense to you. So friends, just now we have discussed what is asset allocation, what are the benefits, what are the disadvantages, what are the pros and cons of investing internationally, right? And all this fact we have covered. Now let's discuss the key investment classes that we have. So friends, that investing is not just about picking random stock. It is all about understanding different asset class. Obviously, you will do asset allocation only when you will understand what are the different asset class which are available. Then only you can do investment, right? So you should understand what are the different asset class available to us, right? And also you should manage risk smartly. So in this slide, we are going to break down some key investment types, right? And how big player protect their money using hedging strategy. Two things we will discuss. What are the key investment classes, and we will discuss the so-called hedging strategy. So the first thing is that small cap, mid cap, large cap. You know about it? See, this refers to the size of the company. So it simply means size of the company. When I say small cap, so some example can be of a small cap can be like some startup, like some business, like some growing business. So we can say like some growing business. Some high risk. So high risk is there, obviously reward is also high. You know it very well. The formula is quite simple. Risk increases, this means reward will also increase. The formula is quite simple here in the case of a small cap. Now if we talk about the mid cap, what is happening here? Because these are the established firm. These are, these are the established firm, right? So in this case it also has a high growth potential. A large cap, these are big stable company. These are big company, these are a stable company, and they have high growth potential, and but slower growth. No, growth potential is not high, the growth is slow. That is called large cap company, right? Now, so I hope this makes sense to you. Now let's discuss high PYE or low PYE. PYE stocks. What is the meaning of PYE? PYE simply means price to earning. It simply means price to earning ratio. So the price to earning ratio tells us if the stock is expensive or not. It simply means whether the stock is expensive or not. PYE tells us the expensiveness of the stock. So if I say high PYE, it simply means investor expect a strong future growth. High PYE means investor expect a strong future growth. And if I say low PYE, it simply means a stock might be undervalued or in slow growth position. So a stock might be undervalued, whatever value it is less than that, or maybe it is in slow growth phase. So large growth phase is high PYE, low PYE means slow growth phase. Now then we have some stock for like value versus growth stock. What is the meaning of value versus growth stock? So if we talk about, means it simply means what is your investment style. It depends on your investment style. So how to categorize based on the investment style? One is called value stock. Value stock simply means that you bought cheap but expected to rise. You bought cheap and you expect that it will rise, right? Means it has high book to market ratio. It has high book to market ratio. That is called value stock. And there is something called growth stock. Growth stock means what? Expensive but fast growing. So you bought, it is quite expensive but it is growing fast growing. So it means low book to market ratio. And now then we have something called treasury and government bond or debt security. So this class we are talking about, you can see it here, treasury and government bond and debt security. So basically safe investment with fixed return, perfect for low risk investor. Obviously in this case you get fixed return, there is no chance of volatility here, right? So you get fixed return. And then we have something called listed and unlisted security, right? IPOs, FPOs, OFS. So it means you are buying share at different stage. You are buying share at different stages. So these are the different kinds of asset class, different stages. What is the meaning of buying share at different stages? Let us discuss. So if we talk about the IPO, it means initial public offering. A company sells share to the public for the first time. So this is a company, this sells shares, for the first time. This is called IPO. What is FPO? FPO stands for follow-on public offering, which means more shares sold after IPO. More shares sold. And then we have OFS, offer for sale, which means existing shareholders sell their stake, right? So I hope this makes sense to you. These are the three types of things we have: IPO, FPO, and OFS. OFS stands for offer for sale, which means existing shareholders sell their stake. Now let's talk about the hedging. So I think it is clear what are the different kinds of asset class we have, right? So based on their size of the company, we can categorize into a small cap, mid cap, and large cap. Based on their PYE, that is price to earning ratio, which means if the stock is expensive, so we know high PYE means expensive stock but future growth, right? And low PYE means the stock might be undervalued. And then we talk about value. What is your investment style? That is called value group versus growth stock, right? So these are the different kinds of asset class that we have. Now that we have understood what are the kind of asset class, now we will move to the hedging strategy, right? So ever wondered about losing money due to currency fluctuation? Obviously you should have wondered, right? This is where hedging comes into picture. So first number fact is that stock market and exchange rate are not always linked. You can see market index and so this, when I say exchange rate, you obviously know this is forex, and market index means stock market. So stock market and exchange rate are not always linked. A booming stock market does not guarantee a strong currency. Remember it. It's not, you can't say that if a stock market is booming then currency will also be strong. No, there is no correlation between them. I hope this makes sense to you. And the second fact you should know. So we are just discussing the fact. Fact number 1 we have just discussed, and fact number 2 is that exchange rate fluctuate due to factor beyond stock performance, right? So exchange rate fluctuation occur for region which are beyond stock performance, like some, I can tell you some example, like political event. I told you that exchange rate fluctuation can occur, can offer due to some political event. It might occur due to inflation, it might occur due to global trade. So these things are not included under the stock fluctuation, right? So that is why I say that exchange rate fluctuation occur due to factor beyond stock performance, like political event, inflation, global trade, right? So these are the factor. And you know, if we talk about this so-called hedging with forward exchange, forward contract, so this forward contract is also a method of hedging. So this forward exchange contract, you know, what the investor do? Investor lock in exchange rate today. So let me highlight the key point. They lock in exchange rate today. The investor lock in exchange rate today, right? For future transaction. So obviously this will reduce the risk in the international investment. So what happened? Risk get decreased. And you know, there is something called hedge portfolio strategy. There is something called hedge portfolio strategy. What we do? We combined global market investment with risk-free asset like bond, right? So when I talk about this portfolio hedge portfolio strategy, right? So let me write down. You can see hedge portfolio. If we talk about this hedge portfolio strategy, what we do? So there is something called global. There is something called global market investment. So global market investment is combined with risk-free asset. Global market investment is combined with risk-free asset like bonds. You know about bonds? Bonds is a risk-free asset. So global market investment is combined with risk-free asset like bonds, and we use something called currency-specific hedge to balance fluctuation. Right, to balance fluctuation, we use something called currency specific hedge. So the best strategy is that hedge the full amount exposed to currency risk, right? So what you do, that you hedge the full amount which is exposed to the currency risk. So that is what we call hedge portfolio strategy. So let me explain you in the layman term what it is talking about. Right, if we talk about this so-called hedge portfolio strategy, what is the general meaning of it? So this point is super important. Like, imagine you are investing money in foreign market. Maybe you are investing in stock in USA while sitting in India. So you are in India and you are investing in USA stock. Fine. Now here is the problem. Currency value keep changing. So suppose if the rupee weakens, right? So you gain, right? So you automatically gain. And if the rupee strengthens, so you lose. So how do you protect your money from this fluctuation? So here is where this hedge portfolio strategy comes into picture. Now how does it work? So first of all, what it does, it combines, it's just a mixture of safe and risky investment. This is the first way it does, right? Hedging. So don't put all your money in foreign stock, balance it with some safer investment. Right, what you do, that that you don't put all your money in one stock, rather you balance it with some safer investment, right? Like a government bond which does not fluctuate much. And then you can use something called currency hedge risk. You see this word written here. You can use something called currency hedge risk, currency specific hedge portfolio. So which means what, this specific fund offset the risk of currency movement, so you are not affected by the sudden exchange rate. And what is the best strategy? That you hedge everything. You see, what is the best strategy? So you hedge everything. Let me write it down. The best strategy is that you hedge everything. What it means? That the safest way is to fully protect your foreign investment from currency risk. This ensures that your money is not impacted by unpredictable shift. So what we learned is that hedging help you protect your investment from currency ups and down. A balanced portfolio reduce risk and increase stability, and a smart investor always hedge their full exposure to the currency risk. So this is what a smart investor do, right? So I hope this makes sense to you. So just now we are discussing the hedging strategy. We have discussed different kinds of asset allocation that we have, right? So understanding investment type and hedging can make or break your financial success, right? So these are the two key pillars of financial success. Now let's discuss all these things using an example. In your book, the CCS technology example is given. So let's discuss. So friends, this is a real world investment project to understand how company make international decision. You imagine this CCS Technology Limited, right? So is planning a project in China. So this CCS Technology is planning a project in China, right? And we will break down the key numbers in simple terms so that you can master foreign investment analysis for your exam. So the first thing is that we have initial investment, right? Land purchase and also future value. Let's discuss this one. So the company is buying land in China for, this is the Chinese yuan currency, which is in I think 30 lakh, right? 30 lakh. Now why is this important? Because land is an asset that might appreciate in value. You know, land is an asset, you know, it might appreciate in value. So this is why our initial investment. Now expected sales price after project completion, you can see it is written, that is land sale value is 35 lakh yuan just from the land appreciation. Sound like a smart move, right? Now key lesson is that when investing in foreign project, always consider how asset like land might gain value over the time. Then we have something called office complex. So the company will build an office complex for 15 lakh yuan, right? But here is the catch, you know, it is a depreciating asset. It is also an asset, but it is depreciating. It will be fully depreciate to 0 over 2 year. You can say salvage value. So wait, does that mean that it become worthless? Not exactly. There is a salvage value. Even if after full depreciation, the company expect to sell the office for 5 lakh yuan, right, at the end of the project. So the key lesson is that even if an asset depreciate on paper, you know, this is very important lesson. From this discussion we have just come to know that is office complex was initially called initially at 15 lakh, and this depreciated asset depreciate on paper. Asset depreciate on paper, or at least for 2 years. But even if the asset depreciate on paper, it might still have something called residual value. It might have something called residual value, and this residual value is called salvage value. That is called resale value, which impact financial planning. Now the question is, how will the company get money for this project? This is the question. Let me ask the question first, then we will answer it. So how will company get money for the project? Right. So you know, this CCS technology is raising fund through GDR. You know GDR stands for Global Depository Receipt, right? So what is GDR? Think of it like a special way for a company to raise money internationally. Instead of directly selling share, they bundle share into GDR and offer them to foreign investor. So through GDR they can raise fund from the foreign investor by bundling the share, right? So you know, 1 GDR is equal to 5 common equity share. 1 GDR is equal to 5 common equity share, and each share is worth rupees 200. Okay, so if you buy 1 GDR, you are indirectly buying 5 share of the company. That is what it means. So what we learned is that GDR allow company to raise fund globally without directly listing on the foreign stock exchange. So you did not list on the foreign stock exchange. So without listing, you can raise money through GDR. Now then we have something called expected return, which is called dividend strategy. You know that current dividend is given 25%, right? You can see current dividend is how much? Current dividend is 25%, and growth rate is 10% per year. This means that shareholder gets a steady payout and it increases every year, right? So what we see that investor love dividend. A high and growing dividend makes share more attractive. So, and then we have something called sales and revenue plan. You can see in the next slide. Let me show you. This is the sales and revenue plan. You know, CCS will sell 10,000 unit every year at 500 yuan per unit, and the price will increase with inflation, right? So clear relation is that if sales increase, it will cause revenue to increase, it will cause profit to increase. Sales, revenue, profit, all three are correlated. More sale, more revenue, more profit, right? So this is the key point. So CCS will sell 10,000 unit every year at 500 yuan per unit, and the price will increase with inflation. More sale, if sales is more, then revenue is also more and profit is also more. And there is something called operating cost. You know, operating cost, what is operating cost? So variable operating cost is given 40% of the sale, means cost that change based on production, right? So, and fixed cost is given, I think it is 22 lakh yuan, right, per year. So expense that remain the same. So what we learned is that company may balance revenue growth with the cost control to stay productive. Then we have something called tax rate. So you know, tax rate in China is 25%, and no extra tax in India as per Government of India policy, thanks to the government policy. And you have the exchange rate given, that spot rate 1 yuan is equal to 9.50 rupees. So every yuan earned in China translate to 9.5 rupees in India. And interest rate is given for India, it is 12%, China is 10%. And cost of capital, that is GDR capital, is 11.39%. This means that cost of raising money through GDR is lower than borrowing in India, because you know interest rate in India is 12% and interest rate for this GDR is 11.39%. So obviously it is lower. So what we learned is that exchange rate, tax policy, interest rate all impact foreign investment. So exchange rate impacted, just now we have seen, and tax policy also impacted, and interest rate all impact foreign investment. So smart investor analyze them before making decision. So now that we have decoded the investment project, you can see how real world financial decisions are made. Now let's cover the calculation part now. So I hope you have got every data with you. So every data has been presented before you, as you can see. Now let's see the main point, that is expected exchange rate as per interest rate parity. So what is the expected interest rate as per exchange rate parity? Let's discuss it now. So friends, have you ever wondered how the future exchange rate are predicted, or how much money a company actually get after selling an asset? So stick around, because we are able to decode this in plain English. So expected exchange rate as per interest rate parity. Now what is this term interest rate parity? In short we call it IRP. What is the meaning of this interest rate parity? So think of it like this. Exchange rate is the future. Exchange rate in the future are not random. You know about it. That is, exchange rate in the future, they are not random. They are not random, right? So they follow a formula based on interest rate in different currency. So they follow a formula based on interest rate in different currency. So you can see the first year the expected rate is one. That means we can say that 1 yuan is equal to 9.67. Just wait a minute. 9.67 rupees. Similarly, so friends, the question is, what is this interest rate parity, which we call IRP? So think of it like this. Exchange rate in the future are not random, right? They follow a formula based on interest rate in different country. So they follow a formula based on interest rate in different country. Here is what is expected for the next 2 years. You can see for the first year the expected rate, that means I can say 1 yuan is equal to 9.67 rupees, and for the second year 1 yuan is equal to 9.85 rupees, right? So this is what is expected for the next 2 years. What does this mean? It simply means that if today 1 yuan is equal to 9.50 rupees, then it is expected to increase to 9.67 next year and 9.85 in the year after that. So this is the spot rate is how much? 9.50 means today the rate is this much, and after 1 year it is expected to increase to 9.67, and after next year it will be equal to 9.85 a year after. Why does this happen? It happened because India's interest rate 12% is higher than the China interest rate, which is 10%. So the rupee is expected to depreciate slightly over the time, right? So this rupee will depreciate. This rupee will depreciate slightly, right, over the time. So interest rate, interest rate is higher in India as compared to the China. That is why rupee is expected to depreciate slightly over the time. You know it very well that interest rate has a impact on currency depreciation, right? So what we learned from this discussion is that higher interest rate in a country usually lead to weaker currency in the future. So since interest rate in India is higher, so obviously you can see the rupee become weaker in the future, right? So that is the key takeaway from this discussion. Now the next thing we have to discuss is the realization. So now I hope this answer your question that what is this interest rate parity, right? Interest rate parity things, I think it is clear. So how expected exchange rate vary as per interest rate parity? You can see it easily that that interest rate difference is there. This causes exchange rate to vary, and if higher interest rate in a country, then its currency will become weaker, right? Then second point is that realization from the land sale. That means now our question is, how much does the company actually get, from selling the land? How much? Let's ask this question first. How much does company get? So let's answer this question first. So friends, okay, now let's talk real money. This CCS technology, this talking about this CCS technology, what it does, it bought land for how much? It bought land for 30 lakhs yen, right, and sold it at the end of project for 35 lakh yen. Sounds like a great deal, right? So they make a profit of 5 lakh yen, right? But wait, there is a tax to be paid. How much tax to be paid? Let me again show you the data which you have just seen. Tax rate is 25% in China, right? So what is the 25% of this capital? So if you calculate the 25% of capital gain, so see how much is the capital. So obviously tax is paid on the capital gain, right? So what is the capital gain? 5 lakh is the capital gain. So what is 25% of this capital gain? So if you calculate 25%, you will get 1,25,000. So the final amount realized is how much? So final amount realized is nothing but 3 lakh. So this tax has been paid, right? From 35 lakh. From 35 lakh, if you subtract 1,25,000, you will get this one, 33,75,000. So this is after paying tax, the company get this much in hand, right? So what we learned from this discussion, that future exchange rate can be estimated using interest rate parity, right? And even if an asset appreciate in value, you need to factor in tax before calculating the final return, right? So smart financial planning means looking at both the gain and tax liability before investing. So I hope this make your concept clear. So how we discuss the realization of disposal of asset, and how we take our exchange rate into consideration. Now here is the third point, realization on disposal of office complex. Let's talk about it. So friends, you know that imagine a company build an office complex, right? Imagine a company build an office complex for how much? 15 lakh. I hope, let me show you again that the office complex was built for how much? You see, office complex cost is 15 lakh. This is the 15 lakh yuan, right? Over 2 years it depreciate completely, meaning it has no book value left. So whenever it say depreciate to 0, it means book value is equal to 0. Right, so it means book value is equal to 0, but can still be sold for how much? But can still be sold for 5 lakh yuan, right? At the end of the project. Great, they are making money, right? But there is a catch. The catch is tax. The catch is the tax. So let's break down the sale proceed. So let me move. So I hope the data is clear to you. 15 lakh is the initial cost of office complex. It depreciate to 0 over 2 years, but tax has to be paid. Salvage value is 5 lakh. Right, so now let's see this data. The same data has been represented here. Realize it, right? So what we are interested in, we want to know how much did they actually get. That is called disposal. When I say disposal of office complex, it simply means that after disposing it, how much they actually get. Let's answer this question. So let me write down the question first. The question is, how much did they, sorry for my handwriting, did they actually get? Right, that's why I'm saying after. Now let's break down. So first of all, you know the sales value at the end of project. The sales value at the end of project is 5 lakh. You know it. What is the obviously what is the book value? The book value, this WDV you call it, or the written down value, or we can also call it the book value. The book value finally is 0. So how much is the capital gain? Capital gain is the 5 lakh, which is the obviously sales value. This is the called salvage value. Right, salvage value. So the total capital gain is 5 lakh, and on this capital gain, how much tax is to be paid? I hope the tax percentage, you know, 25% tax. So 25% of this is 1,25,000. So the amount realized net of tax is 3,75,000. So after the tax, the company gets 3,75,000 in the hand. So this is how they dispose their office complex. Now you can understand it better here. You can understand it better here, right? So we are computing the annual cash inflow, right? We are interested in computing the annual cash inflow. So let's look at the first year. So how much is the annual unit sold? 10,000. What is the price per unit? It is 540. So what is the annual revenue? This is nothing but 54 lakh, right? So this is our total sales, which is how much? 54 lakh. Okay, now we will subtract expenses, then we will get profit. So what are the expenses we have? We have expenses in the form of variable cost. So let me show you how much is the variable cost written. Let me show you the data. Just zoom out a little bit. Yes, so now you can see the variable cost is written here. Let me show you where it is written. You can see variable cost are 40% of the sale. So you have to calculate what is 40% of this 54 lakh. Tell me what it is. So it will be 21 lakh something, and fixed operating cost will be 22 lakh per year. So you can see 22 lakh is the fixed operating cost, and it is increases to rise at the rate of inflation. So after first year it will be somewhat more, and after second year this will be somewhat more, because the fixed operating cost. So these are the two costs we have, right? One is the variable cost, other is the fixed cost, right? So let's come back to here. So now we know what is the variable cost in the first case. So we can easily find it. What is the 40% of 54 lakh? So 40% of this 54 lakh will be 21 lakh 60,000. So this will be 21.6 lakh, right? And we know the after 1 year, taking into account the inflation, our fixed cost become how much? Or and tell me, what is our depreciation? Depreciation, 15 lakh was the initial value of the office. This was the initial value of the office, and it the book value become 0 over 2 year, and it follow the straight line method. So what is the depreciation per year? The depreciation per year is minus 0 upon 2, which is how much? Which is 7,50,000, and this 7,50,000 is the depreciation per year, which is written here. You can see written here 7,50,000. So now you know the depreciation, the variable cost, the variable cost. So I told you that inside this chart there is a part of depreciation also. So this is how much? 7.5 lakh. The fixed cost for the first year is how much? 23,76,000. 23.76 lakh. Right, now the remaining part, this part is what we call as profit before tax. So if you calculate it, what you need to do, you have to subtract this 21.6, 23.7 and 7.5 from the 54. So you get, so the remaining part is what we left is 114,000. Right, so this is your profit before tax. And now how much tax you are paying on profit, which is 25%, so which is 1/4. So 1/4 of this will be how much? 2,85,000. So this much, sorry, 28,500. This will be 28,500. So this much you have paid on tax. So net profit after tax will be how much? 85,500. And now I told you that whenever we calculate the cash inflow, we will add the depreciation back. So just add the depreciation, which was 7,50,000. You get the cash flow, which is 8,35,500 for the first year. Similarly, we go about calculating the cash inflow for the second year. Right, our sales revenue is growing. Right, earlier it was 54 lakh. Now it has grown to 58 lakh something. Also, you can see the variable operating cost, which is 40% of sales. Right, it is also rising. So it more revenue means more production cost. Fixed cost is also increasing, you can see, right? And profit before tax improves from 1,14,000 to 1,83,120. Similarly, tax on profit, that is a net profit and cash flow rises, right? So it means that asset sales bring in cash, but tax reduce the final amount received. Annual business cash flow depend on sales revenue, cost and depreciation. Even if net profit is low, business can still have positive cash flow. Right, so now let's continue our discussion from the next slide. Just let me see. Yeah, here you can see. Now computation of NPV of the project in yuan. Let's calculate it. So friends, ever wondered how business decide whether a project is worth investing in? Right, so this is the answer lies in NPV, net present value. So understanding the investment and cash flow. So imagine a company is considering investment. It needs to spend 45 lakh yuan upfront, right? But how does it get its money back? Because initial investment was how much? 45 lakh yuan. Let me show you where it is written. Let us see. You can see it clearly that initial investment was how much? 30 lakh and 15 lakh. You can see, you add both of them. 30 lakh for land and 15 lakh for office complex. So you add both of them, it will be 45 lakh. So this is the initial investment, and since this is initial investment, we have represented by minus. What does minus sign show? That it is cash. This is cash outflow. Something that is inflow is positive, outflow is negative. That is why we have represented. So this is 0 year, this is first year, this is second year, right? So 0 year, that the entire cash outflow is there, which is of 45 lakh, right? In the first year, annual cash inflow we have just calculated. It is nothing but 8,35,500. You can see it here, right? And in the second year, annual cash inflow is 8,87,340, right? Now, so this is how it is happening, right? And this total value, if you calculate the total, right? Total, so this will give you how much? This will give you minus 45 lakh, right? If you calculate the total here, this will give you this much. And now we have to, while taking the second year, you are getting some disposable income in the form of land net of tax, in the form of office complex realization. This is the amount which you are getting. So these are your outflow. See, remember, these are your inflow. Inflow means you are getting. So this is you, this is your company, right? You are getting some money, you are getting out some money. So in the first year, you have spent 45 lakh. So that is what is represented by negative sign. Whatever is going out has to be negative. in the first year your annual cash inflow was 8,35,500, so it is positive. But in the second year, which is the final year, you have your net inflow. In addition to that, you have some disposable income in the form of land net of tax, because you have invested in land, so you get some profit, and that is nothing but 33,75,000. And also you have disposed of your office complex, there you got 3,75,000. So if you add the total inflow, you will get 46,37,340. And if you calculate the what is our cost of capital, GDR, I think you know it very well, it is 11.39%. Let me show you where it is written. We have just computed it is 11.39%. You can see it here, right? 2.75 plus 0.10. 2.75 is the expected dividend, right? And 2.75 is expected dividend, which is given in the question, and you add this 0.10%, which is the growth rate, 10%. This will give you 11.39%. So this is the rate, this is the cost of capital. So at this rate we will calculate the present value factor. So how to go about calculating it? So it is nothing but 1 by 1 plus r whole to the power n. For the initial thing, you put n is equal to 0. So put n is equal to 0, it will become 1. So the PVF is 1. You put n is equal to 1, that will become our for first year. So it will be 1 by 1 plus r. What is r here? R is 0.0139, right? 0.1139 to the power 1. So it will become 1 upon 1.1139. So this will give you 0.898. This will give you 0.898. For second year, it will be 1 upon 1.1139 chi square. So this will give you 0.806, right? So this is the present value factor, right? Now what we will do? We will multiply it. We will multiply the cash flow with the present value factor to get the PV of the cash flow. You multiply it, you get this much. You multiply it, you get this much. You multiply it, you get this much, right? And we will add all of them. We will add all of them. We will get minus 12025. So the company, what is happening here, right? So what is happening here, that NPV is our negative. So positive NPV means a good investment, and negative NPV means bad investment, loss making project. So the NPV is slightly negative, right? So if this project is not profitable as per the calculation, company might reconsider or renegotiate cost before going ahead. So this NPV help decide if a project is worth it or not, and future money is worth less today, so we discount cash flow, right? And negative NPV means potential loss. Now let's evaluate the project from CCS point of view. Let's evaluate the project from CCS point of view. So friends, how to evaluate a project from CCS, that is this company point of view, sounds complicated. Don't worry, we will break it down in the simplest way possible. The first question is, how does the timing of fund transfer, so let me write it down. How does the timing of fund transfer impact profitability? This is the first question. Should we transfer money as soon as we earn it, or wait until the project end? That is the second question. So let's compare both the scenario. And see which one is better, right? So basically we are discussing how does the timing of fund transfer impact profitability. So you can see the first scenario is here, we are transferring fund as they are earned. As we are earning, we are just transferring the fund. You see that inflow fund are transferred in the year in which the same was generated, right? So now let's see how the picture will change. Sorry friends. Now let's see what is happening here. So the year number 0, how much is the cash flow? It is negative, because this much amount we have invested, the company has invested, we as a company, right? Now basically the inflow fund as transferred in year in which the same are generated. Now what is the exchange rate for the first year? 9.50. This was given in the question. And what is the cash flow? The cash flow was how much? Minus 42,75,000, right? Right. So cash flow coming in. Now for the second year, for year number 1, right? For year number 1, cash flow starts coming in. How much? This much. Exchange rate is this much. So if basically what we are doing, this is in yuan and this is in rupees. So we have just multiplied it. Because here we are taking currency. So we have just multiplied. After multiplication we get this much, and we calculate the PVF, right? So we calculate the PVF, we get this much. Similarly, for the first year, this is in yuan, this is the cash flow in yuan, and exchange rate is given 9.67, right? Exchange rate given 9.67, multiply both of them, you get this much, 80,79,285, and you multiply it by PVF, you get this much, 72,14,802. Similarly, for the second year, cash flow is this much, 46,37,340. You multiply it by the exchange rate. When I say exchange rate means what? It means simply means 1 yuan is equal to how much rupees. So this much yuan will be this much, right? And PVF, you know, PVF you have just calculated here, 0.797, right? So why we are taking 12% here, you might ask me. Why we have taken 11.39%, you might ask me. So you see this 12% is what? You see, you please see this. What is this 12%? Right. So you can see that 12% is the nominal interest rate in India, right? So since we have converted the currency and we are dealing in India, that is what we take 12% here, right? That is why we take 12% here, nominal interest rate in India. So at this interest rate, we are calculating the present value. So we have calculated it, right? And the present value we are getting, the present value you are getting are like this much for the 0 year means starting. For the first year we are getting this much, for the second year we are getting this much. Now in this case, if you calculate the NPV, we are getting positive NPV. Now let's take another case, scenario number 2, transferring fund. So this means project is slightly profitable when money is transferred as it is earned. Now scenario number 2, you can see when the transferring fund as at the end of the project. So at the end of project, if you transfer the fund, so cash flow come in year 2 as a lump sum, right? So what is the amount? You just add both of them. This will be 54,70,840, right? Exchange rate we have done this, and we have calculated the PVF, initial PVF, and at the second year we are not taking, we are not assuming that the fund is coming at the end of first year, right? So we will take exchange rate at 9.85, which was the rate at the end of second year, multiply both of them, we get this much, and PVF is how much? 0.797 at the rate 12%, because we are taking Indian currency, right? So this is the present value interest factor. So after discounting it, right, after discounting it, we get this much. We know whenever we calculate present value, we are discounting it, you know it very well. Okay, present value of future cash flow. So present value factor, you know, and after discounting we get this much. So if you calculate the NPV, you are getting 2,14,257. In this case, we are getting 8,07,000, right? So which option is better? Transferring fund as they are earned give a higher NPV, right? Because money loses value over the time. So getting fund earlier is always better. So the moral of the story is that time value of money is real. Earlier cash inflow means better project profitability. Right. So I hope this makes sense to you. The same thing have been explained here, right? So the same thing have been explained here, you can see, right? So what we learned from this discussion is that NPV is more positive in the case we are transferring fund as they are received, and that is the wise chance we have. Now let's talk about the key point on international portfolio investment. So friends, ever wondered how people invest internationally? How do factors like currency change and political event impact your investment? You know, there are some factors like, you know, currency change, like, you know, political event. So these kinds of factors impact the investment. How does it impact it? So first of all, let's discuss the direct versus indirect channel international investment. So there are two main ways to invest internationally. The first is called direct investment. The first is called direct investment. You know, you invest directly in international stock, bond or company, right? So the first way is called ADR, GDR and FDI. What is ADR? ADR, you know, this is called American Depository Receipt. This means buying foreign company share in US market. Like ADR means you are buying foreign company share in US market. You are buying in the US market. What? Foreign company share. GDR means what? Similar to ADR but in multiple global market, not in only in US. You are using in multiple global market. And FDI, you know, foreign direct investment, when company invest directly in another country. So these are called the direct channel of investment. Either you do in ADR, means in US company, in US market you are buying foreign company share. GDR, you are buying foreign company share in other market, and FDI, you directly invest in another country. So these are called direct channel. There are some indirect channel also. You invest through an intermediary, like a mutual fund or an ETF, exchange traded fund, right? Which then invest in forex market. So this is another way, right? So you might have heard of the global mutual fund, right? So this fund invest in a stock from different country. You might have heard of this ETF. ETF is exchange traded fund, traded like a stock but hold multiple international asset. and you might have heard of these MNCs, right? So investing in Indian company that have a strong global presence. So basically what is happening, that online platform make it easy to invest in global market from your smartphone. Now there are risks also. Let's talk about the risk. Exchange rate risk. The first risk that they are exposed to is the exchange risk. You know that your investment value fluctuate based on how strong or weak your currency is. For example, you invest in a US stock where $1 is equal to 80 rupees. You invest in a US stock where $1 is equal to 80 rupees. Later what happened, it depreciate to rupees 85 per dollar. Later it depreciate to rupees 85 per dollar. So you get less money when selling your investment. So basically you will get less money when you sell your investment. You will get less money. Now suppose if rupee appreciate to rupees 75 per dollar, suppose it appreciate to rupees 75 per dollar instead of depreciating, right? So your investment is worth more in rupees, right? So basically that is, I'm giving you an example that you invest in US stock where $1 is 80 rupees. Later it depreciate to 85 rupees per dollar. So you will get less money when sell your investment, because obviously because dollar value has rupees value has depreciated, and if it appreciate you will get more rupees. You will get your investment is worth more in rupees. So what cause exchange rate risk? So global economic growth or crisis, this is one of the reason, right? Economic growth, crisis, war, global event, government policies and sanction, these are the major causes of the exchange rate crisis. So the moral is that exchange rate can make or break your international investment, right? So this is about the exchange rate. Then we have something called country risk. You know what is the meaning of country risk? See, your investment is affected by the political and economic factor of the country. Obviously political factor, economic factor plays a crucial role in affecting the in investment, right? So for example, if you invest in a company in China but the government introduce a strict regulation, right? So the government of China introduce a strict regulation, so the stock price could drop drastically. So trade restriction, local protest, or even war can impact foreign investment. So let's talk about some key country risk. So key country risk includes political instability, right, like election, trade barriers, this can be another, and social unrest. So these are the key country risks. So moral is that always research the country before investing, right? So let's end our part 1 lecture here. In the part 2 lecture we will discuss the further part, as a return and risk of foreign investment. So I hope this makes sense, whatever we have discussed till now, right? So we have covered till this evaluation method we will discuss. We are basically in foreign investment analysis.